Welcome to Talk Tickers.
It is great to be here.
Now, usually you tune into us for professional earnings call summarization. We are typically the ones combing through the quarterly reports, the corporate guidance, and giving you the bottom line on individual companies.
The micro view, usually.
Exactly, the micro view. But today we are pivoting just a bit for this deep dive. We are covering a really interesting financial topic that sits at the macro level. We are looking at something that is sitting in the portfolio of millions of people right now, often without them even realizing the sheer scale of the engineering involved.
Oh, yeah. It is massive.
We are talking about the absolute engine of the modern retirement system. We are talking about target date funds or TDFs.
The sleeping giants of the investment world. Honestly, they are the quietest multi-trillion-dollar force in the market.
They really are. And I think the common perception is that these are just the boring option. You know, the default choice you get when you sign up for your 401k at a new job, you pick the year you want to retire, you put your money in, and you forget about it.
Right, this set it and forget it crockpot theory of investing.
Yeah, you set the timer and you walk away for 30 years. It feels incredibly passive.
Yeah.
But when you actually crack these things open, when you look at the mechanics, they aren't passive at all.
Not even close. If you look under the hood, a target date fund is actually one of the most complex engineered financial products available to retail investors today. It is a derivative of human capital theory, behavioral hedging, and some very sophisticated threshold-based algorithmic trading strategies.
Which sounds incredibly intimidating when you phrase it like that.
It does, but it's important to understand. It is not just a simple program that says sell stocks and buy bonds every year. It is a dynamic breathing machine making daily calculations.
That is exactly the hook for today's deep dive, because I think most people assume it is just a straight line. I turn 40, they sell some of my stocks. I turn 50, they sell some more. But the reality is that these funds are driving trillions in market capitalization. And the engine driving them, what we call the glide path, that determines whether you retire on time or whether you are, forced to work an extra 5 or 10 years.
It really is the difference between retiring with a sturdy safety net and retiring on a tightrope. And what makes this deep dive so timely for you listening is that market volatility interacts with these funds very differently depending on who actually built them.
Right. They are not all the same.
Exactly. The construction matters. How the algorithm handles a market crash tells you everything you need to know about your retirement security.
So let us unpack this. We need to start with the basics for anyone who might be slightly new to the structural mechanics. What exactly is the working definition of a target date fund in this context?
At its core, a target date fund is a collective investment scheme. So that is usually a mutual fund or a collective trust. The defining feature, the thing that makes it unique, is that it automatically rebalances its asset allocation based on a specific target year.
And that year is generally the year you, the investor, expect to retire.
Correct. So if you plan to retire in 2050, you buy the 2050 fund.
The promise being that it offers a single, fully diversified portfolio that evolves for you. It starts aggressive when you are young, seeking high returns, and then becomes conservative to preserve your capital as you get older.
And it does all of this without you ever having to lift a finger or make a single trade.
Which is brilliant marketing. But the scope of what we need to discuss today goes way beyond that marketing pitch, because we aren't going to sit here and talk about specific stock picks within these funds.
No, the individual stocks don't matter as much as the structure.
We need to analyze the structural mechanics. We are going to break down the glide path. We're going to dive into the massive industry debate between to versus through architectures. And we will look at the rebalancing algorithms that are actually executing trades every single day behind the scenes.
And we will also touch on the integration of alternative assets. Things like commercial real estate being folded into these funds, which is a fascinating newer wrinkle.
Oh, absolutely. The real estate angle is super interesting. But before we get into the heavy math and the algorithms, I want to step back into the history. Because these things didn't just fall out of the sky.
No, they are actually a relatively modern invention in the grand scheme of finance.
Take us back to the origins. Who actually came up with this concept?
We have to go back to the early 1990s for the invention. The credit really goes to Donald Luskin and Larry Tint. They were working at Wells Fargo Investment Advisors at the time.
Which eventually became Barclays Global Investors, right?
Yeah, BGI.
Yeah.
Total heavy hitters in the institutional space. The original concept they were working on was what they called life cycle investing.
Life cycle investing.
Okay. They recognized a fundamental flaw in the retail market. Asset allocation is basically the hardest part of investing for a normal person. Most people either take way too much risk and blow up their accounts, or Much more often, they take nowhere near enough risk.
They leave it all in cash because they are terrified of the stock market.
Exactly. So Luskin and Tint wanted a simple, elegant solution that did the hard mathematical work for you.
So it starts in the early 90s, but it didn't really explode right away. I mean, in the 90s, everyone was still stock picking, right? People were day trading .com stocks. When did the TDF actually become the massive default juggernaut it is today?
The absolute turning point, the explosive catalyst for this entire industry was the year 2006.
2006.
Specifically, the passage of the Pension Protection Act of 2006.
The PPA.
Yes. Honestly, this is probably the most important piece of financial legislation regarding retirement in the last 30 years. You really have to understand the corporate environment before 2006 to get why this was so huge.
Set the scene for us.
Before the PPA, employers were absolutely terrified of liability.
Liability for choosing investments for their employees.
Precisely. If an employer said, hey, we're going to auto-enroll you and put your 401k money into this specific stock fund, and then that fund lost 20% in a market correction, the employer was terrified of getting sued by their own staff for breaching fiduciary duty.
So they just didn't do it.
They didn't do it. The default option for most company plans, if you didn't proactively pick your own investments, was a money market fund or a stable value fund.
Which earns basically zero interest, maybe 1% if you're lucky.
Exactly. Millions of people were being auto-enrolled into cash. And because of inertia, they just left it there. They would wake up 20 years later ready to retire and realize they hadn't made a single dime in actual market returns. Their purchasing power was basically destroyed by inflation.
That is a systemic disaster. So how did the Pension Protection Act fix this?
It created something called a QDIA. That stands for Qualified Default Investment Alternative.
A safe harbor.
A massive safe harbor. The government basically stepped in and said, look, if you, the employer, put your employees' default money into a diversified, age-appropriate vehicle like a target date fund, you are fully shielded. You are not legally liable for the normal market investment performance.
And the floodgates just opened.
Instantly.
Right.
Almost overnight, TDFs became the default vehicle for almost every major 401k plan in America. We saw staggering asset inflows. And it really shifted the entire market structure because suddenly you have these massive, incredibly steady flows of capital going blindly into these algorithmic funds every 2 weeks when people get their paychecks.
It effectively automated stock market participation for the entire American workforce.
It did. It forced diversification.
Yeah.
And it anchored that participation to a very specific academic theory called human capital theory.
Okay, let us really unpack this because this is the theoretical foundation of the whole machine. Human capital theory. It sounds a bit like something out of a dystopian sci-fi novel, but it is actually a deeply profound economic concept.
It is the bedrock of the Bride Path. The idea relies on the concept of total wealth. If you are sitting down with a high-end financial planner, your total wealth is not just the money sitting in your checking account or your brokerage. Total wealth equals your financial capital plus your human capital.
Financial capital being your actual saved dollars, and human capital is what your future wages.
Exactly.
Yeah.
It is your future earnings power. It is the present value of all the paychecks you haven't even received yet.
So if I am 25 years old, just out of school, I have basically zero financial capital. I am broke. Maybe I have student debt, but I have massive human capital.
You are a billionaire in human capital. You have 40 solid years of wage earning ahead of you. And here is the absolute key insight from the theory for most normal people. Human capital behaves exactly like a bond.
Because it pays a regular coupon, right? Your biweekly paycheck is basically the yield on your human capital.
You hit the nail on the head. You are the bond. It is a steady stream of payments. It has relatively low volatility, assuming you stay employed in your field. It is reliable income.
Okay, so if I looked at my total wealth pie chart at age 25, and 95% of it is this super safe bond-like human capital, how should I invest the tiny little 5% sliver of financial capital I am managing to save?
You should take maximum risk. You should be heavily in equities.
Because my total wealth is already so incredibly conservative due to my future wages, I need the stock market to balance out the total economic picture.
Precisely. You need the aggressive growth of equities to offset the conservative nature of your labor. But then, as you age, the seesaw starts to tip.
Right, because by the time I am 65, my human capital is practically zero.
Exactly. You don't have 40 years of wages left. You might have 1 year left. You might have zero. So that massive, safe, bond-like asset that anchored your life is gone. To replace that financial stability, your actual financial capital must pivot to become bond-like.
That makes so much sense when you frame it that way. It is not just the old cliche of, well, old people can't take risks because they have weak hearts. It is strictly mathematical. Older people have lost the bond component of their life, their job, so they have to physically buy actual bonds to replace it in their portfolio.
That is the exact mathematical engine. And that engine is visualized in what the industry calls the glide path.
The glide path. We hear this term thrown around constantly in financial media.
Think of it as a chart. On the horizontal x-axis, you have your age, moving from 20 to roughly 80 or 90. On the vertical y-axis, you have the percentage of your portfolio invested in high-risk equities, like stocks. The glide path is simply the line that plots that exposure over time.
So in the very beginning, what we call the accumulation phase during your early career, what does that line look like?
It is high and it is flat. Typically, you're looking at 90% plus in equity exposure. The focus here is entirely on capturing the equity risk premium.
Yep.
You're just trying to grow the pile as aggressively as possible while your human capital acts as your safety net.
And then usually around age 40 or 45 comes the descent.
The descent. As the target date approaches, the algorithmic fund systematically starts selling your equities and buying fixed income. The line on the chart begins a gradual downward slope.
Less stocks, more bonds, month after month.
Correct. And then finally you reach the landing.
The landing, meaning the target date itself, the day you retire.
Yes. The landing is the specific asset mix at that target year. And this is where the industry splinters. This is where it gets incredibly controversial, because a rational person would assume that all these 2050 funds or 2030 funds land at the exact same spot.
Right. If I retire at 65, I retire at 65. The math should just be the math. A 2030 fund at Vanguard should look exactly like a 2030 fund at Fidelity.
But they don't. They look wildly different under the surface. And this leads us to the biggest differentiator in the entire space, the debate between to versus through architectures.
To versus through. It sounds like a grammatical debate about prepositions, but we are talking about millions of dollars in real-world risk exposure. Let us break down the two retirement funds first.
Let's do it. A to fund is designed with a very specific philosophy. They believe that the absolute biggest risk you face as an investor is market risk right at the finish line.
Meaning a market crash the day before your retirement party.
Exactly. They want to secure the bag. The mechanism of a to fund is that the glide path reaches its absolute most conservative allocation at the target date, let's say age 65. Once it hits that date, the asset allocation freezes, or in some cases, the fund actually dissolves and merges into a static, highly conservative income fund.
So the slope goes down during your 50s and 60s, hits age 65, and effectively flatlines. It stops selling stocks because it has already sold most of them.
Correct. A major proponent of this architecture is American Century. There is a deeply held philosophy here, often described using a marathon analogy.
How does the marathon analogy work here?
If you are organizing a marathon for millions of normal people, the primary goal isn't to have one single person finish with the absolute fastest record-breaking time. The goal of the organizer is to ensure the maximum number of people actually cross the finish line without collapsing.
Meaning they want to minimize the number of people who get totally wiped out by a market crash right before the end, even if it means sacrificing some growth for everyone.
Right. They argue that to funds account for the very real human behavior that happens at retirement. People might take their lump sum out to buy an annuity. They might roll it over to a local financial advisor. The fund needs to be finished doing its de-risking work by that target date, so the money is safe and liquid.
That sounds incredibly prudent. What are the downsides to that to approach?
One massive downside, longevity risk.
The risk of simply living too long.
The risk of outliving your money. If you get too conservative at age 55, let's say your fund drops down to 20 or 30% stocks, you have a limited market risk. Sure. But you might not have enough growth left in the portfolio to fight inflation for the next 30 years.
Right, because if you retire at 65, you might easily live to 95. That is 3 full decades where your money is slowly losing purchasing power if it is just sitting in bonds.
Which brings us to the counterargument, the through retirement funds.
Through funds. And these are the ones favored by the real titans of the industry, right?
Yes. Vanguard, T. Rowe Price. They are massive proponents of the through philosophy. Their fundamental argument is that retirement is not the finish line at all. It is just a transition point. You are simply entering a 30-year distribution phase.
You are not cashing out and putting the money under your mattress. You still need that capital to compound.
Exactly. So the mechanics of a through fund reflect that. The asset allocation continues to shift, continues to gently de-risk for 10, 15, or even 20 years after the target date.
Wait, so if I buy a 2030 fund and I retire in 2030 at age 65, the fund's algorithm is still actively adjusting my risk until I am 80 years old.
Yes, it absolutely is.
Yeah.
Companies like TIAA talk extensively about adjusting well into the retirement years. The glide path doesn't hit a flat line at 65. It hits a very gentle slope that just keeps gliding downward until you reach age 80 or 85.
So the actual asset mix, the ratio of stocks to bonds, must be vastly different at age 65, depending on which fund you own.
Drastically different. This is the part that shocks people. A through fund might have 50% or even 55% of its assets still in equities at age 65. A TOA fund might have only 30%. That is a 25% delta in stock market exposure on the exact same target date.
That is huge. So if the S&P 500 crashes 30% the week you retire, the person in the through fund feels a massive amount of pain compared to the person in the to fund.
They absolutely do. And that is the intentional trade-off. Through funds focus hyper-specifically on longevity risk. They want to make sure you're not eating cat food in your 90s. To funds focus on market risk. They want to make sure you don't lose half your nest egg on your literal last day of work.
It is genuinely fascinating that two financial products with the exact same consumer name, like Target Date 2030, can have such fundamentally opposing risk profiles based entirely on that one structural preposition.
It dictates everything about your financial future. And there is a ton of high-level academic research driving this, focusing on a metric called economic utility.
Economic utility. Okay, that sounds like ivory tower jargon. What does it actually mean for you listening?
It is basically a mathematical way of measuring human satisfaction. It operates on the premise that investing isn't just about ending up with the highest raw dollar amount on a spreadsheet. It is about balancing the severe emotional pain of loss, what behavioral economists call loss aversion, against the real-world satisfaction of consumption.
So it is trying to measure happiness, basically.
Happiness and security. The argument from the through fund advocates is that because modern medicine is keeping people alive so much longer, the utility, the vital necessity of having purchasing power at age 90 is incredibly high. Therefore, you must accept the higher volatility at age 65 to ensure you have that equity growth working for you.
Because your spending needs change dramatically. You might spend a lot more on specialized healthcare at 85 than you ever did on vacations at 65.
Exactly. And to fund that late-stage consumption, simple bond yields aren't going to cut it. You need the compound engine of equity growth working for you straight through your retirement years. It is a direct critique of the older, simpler wealth models that just assume spending dropped off a cliff when you got old.
Okay, so we have a solid grasp on the architecture now. The to versus through debate. The overall glide path. Now, I want to look under the hood at how these things actually operate on a day-to-day basis. Because it is fine to draw a line on a chart, but real markets move chaotically. If stocks go on a massive rally, your carefully planned 60-40 portfolio suddenly becomes a 70-30 portfolio just through price appreciation.
And the moment that happens, your risk model is totally broken. You're exposed to more volatility than the algorithm intended. So the portfolio manager, or rather the algorithm, has to rebalance. It has to sell the winners high and buy the losers low to reset the ratio.
How exactly do they execute that across trillions of dollars? Is it just a guy hitting a button on the first of every month?
There are two main methodologies competing in the industry right now: calendar-based rebalancing and threshold-based rebalancing.
Calendar-based seems the most intuitive. Just reset the portfolio every quarter, right?
It is very simple to program and execute, but deep research from major players like Vanguard strongly argues against it.
Why? What is the flaw in a set schedule?
It comes down to two major inefficiencies. The first is called drift. Let's say a massive market shock happens in the middle of the month, say March 15th, 2020. Total pandemic panic. Stocks were in free fall.
A completely unprecedented drop.
Right. But if your fund isn't scheduled to rebalance until March 31st, your portfolio is completely out of whack for 2 full weeks during the most critical volatility event of the decade. Your equity allocation drops way below target, and you miss the start of the rebound.
You are essentially exposed to risk parameters you never signed up for, just because of what day it is on the calendar.
Exactly. And the second major flaw is transaction costs. Imagine the opposite scenario. The market is totally quiet for a month. Nothing really moves. But the calendar says it is the final Friday of the quarter. Time to rebalance. The fund might execute millions of tiny, unnecessary trades just to get back to perfect alignment, incurring massive institutional trading costs for basically zero mathematical benefit.
So the calendar is either too slow in a crisis or too expensive in a calm market. What is the alternative?
Threshold-based rebalancing. This is the truly sophisticated algorithmic approach. Instead of a calendar date, the fund sets a tight tolerance band around the target asset allocation, say 200 basis points, which is 2%.
So if my target is exactly 60% stocks, the algorithm doesn't even look at it unless it drifts up to 62% or falls to 58%.
You got it. You only execute trades when the allocation physically deviates by that specific threshold amount. The data clearly shows that this specific strategy drastically reduces transaction drag. You trade far less often in quiet trending markets.
But it creates incredibly tight tracking in volatile markets.
Exactly. If the market crashes 10% in a single Tuesday session, the threshold band is triggered immediately. Boom. The algorithm rebalances that very afternoon. It systematically buys the dip instantly, stripping emotion totally out of the equation.
That is a staggering difference in execution.
It is. And there is actually another hidden layer of nuance to how they do this. When the algorithm triggers a threshold rebalance, it does not go all the way back to zero.
What do you mean by that?
Okay, if your threshold limit is 2% drift and the market moves and hits 2.1%, triggering a trade, the fund doesn't rebalance you all the way back to the perfect absolute target. They intentionally rebalance to a destination somewhere inside the threshold band, say 175 basis points away from the target.
Wait, why wouldn't they just go all the way back to perfect alignment if they are already making the trade?
To save money on market impact and trading costs. By stopping short, it gets you close enough to be perfectly safe within the risk parameters, but avoids the exponentially higher expense of squeezing out that last mile of mathematical precision. It is a brilliant optimization game played across hundreds of billions of dollars.
That is the hidden engineering I was talking about at the start. It is not just a colorful pie chart in a glossy brochure. It is a highly optimized algorithm designed to minimize every possible fraction of friction.
And we also need to talk about exactly what assets they are rebalancing, because the specific components inside these funds have evolved significantly over the last decade.
Right. It is not just the S&P 500 and a generic government bond fund anymore.
Far from it. Inside the equity portion, we see massive debates regarding home bias. The split between U.S. domestic equities and international equities is routinely 60-40 in many of these funds.
60% U.S., 40% international. That actually surprises a lot of everyday investors who assume they are just buying the American economy when they buy a retirement fund.
Oh, absolutely. And the fixed income side, the bond portfolio, isn't just vanilla aggregate bonds either.
What are they layering in there?
You will see heavy allocations to short-term TPS, Treasury inflation-protected securities, specifically to fight off unexpected inflation spikes near retirement. You will also see a lot of international fixed income. But crucially, that international debt is almost always hedged to remove currency risk.
Hedged meaning they use derivatives so the currency fluctuations don't impact the return.
Right. They want the higher interest rates offered by foreign central banks, but they do not want the wild daily fluctuation of the euro or the yen against the dollar. It is a very precise exposure they are hunting for.
And then there is the approach taken by providers like TIAA. They are doing something very specific and unique with alternative assets, specifically real estate.
Yes, this is a massive differentiator for TIA's lifecycle funds. They actually include direct commercial real estate in their target date portfolios, up to a 5% allocation in some cases.
Wait, direct real estate? You mean they aren't just buying publicly traded REITs, they're actually holding physical commercial properties within the structure of a mutual fund?
Correct, or at least highly direct private exposure to those properties. The rationale behind this is capturing the illiquidity premium.
Explain the illiquidity premium for us.
Private commercial real estate doesn't trade on a public exchange every second of the day, so it doesn't move in a volatile lockstep with the stock market. It provides genuine, deep diversification. And because target date funds are inherently extreme long-term vehicles, TIAA argues that the fund can easily afford to hold illiquid assets that offer higher yields.
It makes total sense. If I am 25 and I am putting money away that I literally cannot touch without penalty for 35 years, why do I need daily liquidity on every single cent? I should be getting paid extra to lock that money up in a building.
Exactly. The liquidity is wasted on a 20-something. And interestingly, they integrate this real estate exposure deeply into the life cycle. They don't just sell it when you retire. They often hold that real estate allocation until roughly 10 years past the target retirement date.
So they carry the commercial buildings right into your retirement distribution phase.
Yes. Again, it is a tool for fighting that longevity risk. They are using the steady rental income generated from those physical assets to stabilize the cash flow of the portfolio during the most vulnerable years of your retirement.
This connects perfectly to the behavioral risks facing the individual investor. We talked about longevity risk earlier, but we really need to focus on what the industry calls the red zone.
Yes, the sequence of returns risk. This is the absolute nightmare scenario for any financial planner.
Walk us through the mechanics of the red zone.
Okay, let's look at the math. Imagine you are 25 years old. You have managed to save $10,000 and it is fully invested. The market drops 20% in a bear market. You lose $2,000 on paper.
Which is annoying, but you have 40 years to make it back.
Right. And more importantly, you are still working. Every 2 weeks, your automated 401k contribution buys new shares of the market at a 20% discount.
It is actually a phenomenal buying opportunity when you are young.
Exactly. Now, fast forward. Imagine you are 65 years old. You have saved $1 million. You finally retire today. Tomorrow, the market drops 20%. You instantly lose $200,000 on paper.
That is psychologically devastating.
It is. But structurally, it gets immensely worse. Because you are retired, you no longer have that bond-like human capital. You are now withdrawing money every month just to live and buy groceries.
So you are actively selling your investments while they are down 20%.
Yes. You are permanently locking in those massive losses. You are selling double the number of shares just to get the same amount of cash you needed last month.
You are digging a mathematical hole that you physically cannot climb out of because the capital is gone forever.
Exactly. If that sequence of events happens in the first 5 to 10 years of your retirement, the red zone, the math says you are statistically highly likely to run out of money entirely before you die. That is sequence of returns risk. It is all about the order in which the returns happen.
And this brings us right back to the glide path architecture we discussed.
It does. A true fund, with its steeply declining glide path right before age 65, is actively trying to eliminate this specific sequence of returns risk. By getting hyper-conservative at retirement, they are trying to guarantee that a sudden 20% market drop doesn't fracture your nest egg right when you start taking withdrawals.
But the through fund, Vanguard and T. Rowe Price, they look at that same red zone and they say, well, we will just take that risk.
They do. They explicitly say, we accept a higher degree of this sequence risk because the alternative, living safely for 10 years but then completely running out of money at age 95 because inflation eroded your purchasing power, is mathematically worse. It is a profound pick your poison situation for the investor.
But there is another layer here that we haven't touched on yet, the behavior gap. We can sit here and engineer the perfect math. We can build the perfect threshold algorithm, but we cannot engineer the human brain.
That is the ultimate chaotic variable. The historical data consistently shows that individual investor returns almost always lag behind the actual fund returns.
Which seems impossible. If I own the fund, I should get the fund's exact return. Why do people lag?
Because people buy high and they panic sell low. It is human nature. The market drops violently, they get terrified watching the news, they log into their account, and they sell everything to cash at the exact bottom. Then, a year later, the market rallies to new highs, they get intense FOMO, and they buy back in at the absolute peak.
The ultimate wealth destruction cycle. So how do target date funds fix this psychological flaw?
By entirely removing the human from the process. It imposes cold discipline. By wrapping the daily rebalancing mechanics invisibly inside the fund structure, it prevents the investor from tinkering.
When the market completely crashed in March of 2020, the TDF algorithm didn't panic.
Not at all. It looked at the threshold bands, saw that equities had dropped below the tolerance limit, and it coldly executed buy orders for stocks into the teeth of the crash.
Well, the average human being would have been selling everything they owned.
Exactly. The TDF effectively acts as a behavioral hedge against your own worst evolutionary instincts. Providers like T. Rowe Price talk about this extensively in terms of utility theory again. The ultimate goal of these products isn't just generating the highest theoretical return on a spreadsheet. It is maximizing your lifelong financial satisfaction. And there is absolutely zero utility, zero satisfaction in panic selling the bottom of a bear market and ruining your retirement.
So the entire shape of the glide path is mathematically designed to maximize that long-term satisfaction.
It tries its best to. It attempts to perfectly balance the visceral pain of financial loss with the required pressure of financial gain, constantly recalibrating it to your specific age and time frame.
It is really about outsourcing your willpower to a robot.
That is honestly a great way to summarize it. You are hiring an emotionless algorithmic robot to be disciplined for you for 40 straight years.
But in finance, you have to make absolutely sure you hired the correct robot for your specific situation.
Which leads us to the single most critical distinction you need to make.
We have covered a massive amount of ground here today. We've gone all the way from the Pension Protection Act of 2006 to the minutia of threshold-based rebalancing bands. But if a listener is sitting at their kitchen table right now, looking in their 401k statement, what is the absolute core thing they need to figure out?
It comes down entirely to to versus through.
So this is the one question.
The one question you absolutely must ask and find the answer to is, does this specific fund manage to retirement or through retirement?
Why does that one technical distinction matter more than the expense ratio or the big brand name on the prospectus?
Because that single architectural distinction dictates your actual equity exposure at age 65. It is potentially a difference of 20 to 30% of your total wealth sitting in the stock market. That single fact determines whether you are protected against a violent market crash the day you quit working, or whether you are protected against slowly running out of money at age 90.
And as we discussed, neither answer is inherently wrong for the market.
No, mathematically, they both have immense merit. But one of them is definitely wrong for you personally. If you have a rock-solid, inflation-adjusted government pension, maybe you can easily afford the higher equity risk of a through fund. If you have absolutely zero other savings, and this is your entire lifeline, maybe you desperately need the immediate safety of a to fund. But you have to know which machine you are actually strapped into.
You can't just look at the date on the label. Seeing target date 2030 tells you exactly when the fund lands, but it tells you absolutely nothing about how it plans to land.
Exactly. You have to take 10 minutes, pull up the prospectus online, and actually look at the glide path visualization chart. Look at the literal line. Does it hit a wall and flatten out completely at the target date, or does it keep sloping downward for another 20 years?
Let us wrap this deep dive up with some final thoughts for the audience. I think we have clearly established today that target date funds are highly dynamic, algorithmic portfolios. They are absolutely not static, boring savings accounts.
They are massive engines designed to perfectly balance your invisible human capital with your tangible financial capital over a 50-year horizon.
We learned that the behind-the-scenes rebalancing methods, specifically threshold versus calendar, have a massive impact on your net returns simply by optimizing transaction costs.
And above all else, the to versus through architectural debate is the primary risk lever controlling your financial destiny.
So any final provocative thought for the listener to take away? Something beyond the basic mechanics we covered.
Here's something to mull over. Right now, target date funds group millions of people together purely based on their birth year. A 25-year-old software engineer making $200,000 is in the exact same 2065 fund as a 25-year-old barista making minimum wage. But their human capital profiles are wildly different.
Oh, wow. Yeah, completely different risk capacities.
Exactly. The next massive frontier in this industry won't be cohort-based funds. With the rise of AI and zero-commission algorithmic trading, we are moving toward hyper-personalized glide paths. Instead of a target date 2065 fund, you will eventually have a target date U fund. An algorithm that dynamically adjusts its threshold bands and equity exposure based on your specific salary trajectory, your mortgage debt, and your real-time health data, rebalancing constantly. The era of the one-size-fits-all glide path is probably coming to an end.
An individually tailored AI glide path. That is incredible to think about. And it perfectly proves that while these current funds are designed to be set it and forget it, the astute investor knows that completely forgetting your asset allocation is never a winning strategy. You always have to verify that the glide path matches your personal reality.
That is the ultimate takeaway. Know what engine is driving your money.
Well said. Thank you for diving so deep into this with us today.
It was an absolute pleasure.
And thank you all for listening. We will see you on the next Stock Tickers.